Welcome to the Stage Analysis Midweek video. It is the Wednesday, the 12th of October 2022. I'm just going to start today's video with a brief look at what's been going on in the major indexes year to date. So, gathered a quick perf chart of Nasdaq, MOSC, Dow Jones, S&P 500, Russell 2000, Nasdaq 100, the IBD 50, and the ARK Innovation Technology Fund, the ARK-K, just to get a sort of general overview of the year-to-date market as we're approaching 200 days at the moment. So 197 at the moment tracking. So you can see, obviously, everything year-to-date is down from as much as 62% down to 20%. So if we go down to here, I have to scroll a little bit to get past the bar. You can see obviously the drops that we've seen across the market. Notice the Nasdaq 100 and the actual Nasdaq Composite are tracking very, very close to each other. Actually, when I looked at the individual chart of this, so whereas at the moment Dow Jones is beating everything. So year to date minus 19.61, but everything is down heavy, especially the ARK-K, which obviously I imagine many people are well aware of. Obviously comes up in the headlines quite a lot. So there's not too much positivity out there, but we're going into, the reason I wanted to highlight this is that we're moving into earnings season this week. So starting with the major banks starting to report at the end of the week. I think we had a few reports come out today. I think Pepsi reported and a few others, but it starts to kick off in earnest in over the next few weeks. And we get, I think within I highlighted earlier on the Twitter feed that basically 2 to 3 weeks time we will have had up to 2/3 of the Nasdaq 100 will have reported. So with expectations, with the market down obviously in a deep stage 4 decline already, and obviously expectations massively low, then there's obviously a chance of a surprise to the upside in that regard. So, but we will see. Obviously, we could obviously just continue down in stage 4, but obviously with such low expectations, then we obviously need to be alert for any kind of positive signs that do come out from the earnings results. We get some obviously earnings gaps give great opportunities for trading. So we'll obviously be monitoring that closely over the next couple of weeks. Right, let's move on to the individual indexes quickly. So before we get into the breadth and the watch list post later in the video. So S&P 500, it's been a dire week so far. Very, very slow, horrible action that we've seen, but consolidating near the lows of the range. Volume remains reasonably high. Supply continues to be fairly high. So if I actually add on the Force Index, which tracks price and volume in indicator form, you can see supply is still, even though it's come off a little bit, it still remains fairly heavy. We're right at the bottom of the range, so not a lot of hope at the moment in terms of in the indexes, but obviously we're in position for a potential spring type event, but could quite easily just continue making lower lows and make a stage 4 continuation, which it already has to a certain degree, but we haven't yet had that major commitment. Percentage of stocks above their 20-day moving average at the moment remains in the lower zone, 15.4%. So until we start to see this moving back up through this key 30% level, we remain on a difficult environment in the short term there. If we look at the intraday chart of this, you can see the potential spring event that's attempting to happen here. We had the first attempt at it, which failed, and it's come back down again. There is some minor divergence in supply at the moment, which has been coming off as it gets down the bottom of the range. But unless we get a sudden reversal, sharp move back up above the near-term moving averages in here, then at the moment we're still looking fairly weak at the moment and could make a potential stage 4 continuation. But obviously hasn't done yet convincingly, so still in the sort of critical zone as we start to move into that earnings phase that's coming up. Nasdaq Composite, similar, made a lower low, hasn't yet made a major commitment to the downside, but obviously could quite easily break to the downside from its current positions, continuing to make lower lows since we obviously all year long here. So Russell 2000, on the other hand, showing a little bit of relative strength now, starting to outperform the S&P 500. You can see it's actually made a minor higher high today above what we call the zero line, which is the Mansfield relative strength, like the 252 on the day here, so 52-week moving average of the relative strength of the index versus the S&P 500 there. So starting to outperform the S&P 500 in the near term, pretty much for the first time this year. It's been underperforming, well, for the last year or so now. So again, we need to, for a sort of positive action on this one, we need to see a break above this 176 kind of area up here. But obviously on the downside, if it starts to break below this 162 kind of area, then potential for a stage 4 continuation lower. But again, still a little bit in no man's land at the moment. Potential spring type area in the test at the moment, but holding better than the other indexes so far. QQQJ, which is the Nasdaq second 100 stocks, again making lower lows at the moment, but consolidating just around the low. So again, potentially in spring type area here, if it starts to turn back around like so, could potentially form a spring, but obviously still hasn't managed to show any sign of strength at the moment, so could quite easily make a stage 4 continuation lower and well below that zero line at the moment. The big gap between ARK-K, similar small spring attempt today, plus 1.32%. It's been building a base since around May time, but again, there's continued to make lower lows, so we need to see it start to overcome some near-term levels in order to start to get a little bit more bullish on that. And this is our weakest index overall, as I showed at the start of the video. It's down over 60% year to date, which obviously is terrible for a major ETF. So this needs a lot of recovery in order to get anywhere near stage 2 again. I think we've got a 50% move just to get back up towards the 200-day moving average. So in order to get back into stage 2 type environment, it would probably need to be getting up and clearing somewhere around the 60 area currently if it had a sudden sharp move. So, but for the moment, potentially we're in stage 4B at the moment still. It could be developing in stage 1 base structure. Let's have a look on the weekly chart of this. So there's potential that this is potentially forming a stage 1 structure, but again needs to prove itself a lot more. This attempt up here to the 30-week moving average obviously sold off fairly strongly again, so we'd not need to see this start to get back above the 10-week moving average and then start to hold that, start to recapture that 30-week moving average, and for them to start to get back in line again in order to start considering it stage 1. So at the moment I'd still give it a stage 4B rating, so which means late in stage 4B in stage 4. So all the B means is late in the stage, which, as you can see, it's been in stage 4 since this significant breakdown at this point down here. So quite a while now. Look at the VIX, remains elevated still. We're at 33.57%. So still multiple percent moves a day with the VIX at this kind of level. As I mentioned in every video, we need to start seeing it get back down below this 200-day moving average in here and back into a more positive area. So for the moment, it remains elevated. So obviously negative on the breadth front there. From a sector breadth point of view, I did a different kind of post yesterday, as obviously the market's so negative, very little in the way of the watch list yesterday. So it would be more useful to look at what was going on in the sector breadth, as I hadn't done it for around 3 weeks or so. So you can see the current distribution of all of the sectors in the market compared to what's going on in the actual major market indexes themselves. We've got the NYSE and the Nasdaq here as well. So compare the positions. Actually, it might be able to. A few weeks prior, we've actually declined by a further 10.27%. So we're now down to 18.9% overall. So down in the lower zone, very much so at the moment, and even like deep in the lower zone at the moment. So we're in the stage 4 environment. So anything below the 40% level here is the stage 4 zone. Anything between the 40 and 60% zone is the stage 1 or stage 3 zone. So we've only got energy currently in stage 1 or stage 3, and then anything above 60% we consider in the stage 2 zone. So basically the vast majority of the groups at the moment, we've got 10 sectors here, are in the stage 4 zone, and only energy is in the stage 1 or stage 3 zone. So very, very, you could say, oversold at the moment. I've seen it more extreme than this before, so it can get to lower levels, and a week prior to this it was actually lower, so it got down to, I think I wrote in the post, 14.76%, which was the year-to-date low for this. So it did get low. We had multiple stocks in the 10 to 20% sectors in the 10 to 20% range. Real estate remains our lowest at the moment. It's all the way down at 3 point something percent. So if I go down here, you can see the actual rankings here. It's only 3.76% in the real estate, 42% in energy. So very, very weak across the board at the moment. Had a little bounce, as obviously last week was lower, but down compared to, we're still down more than 10% where we were 3 weeks ago when I last did it. If you have a look at the individual charts of this, these give a much better look at what's going on. The top chart gives us our broad picture, tells us where we are quite clearly. We're in stage 4. Obviously for this, you want to start seeing groups start moving up and out. So once we start seeing sudden shifts, so for example, we start seeing them move up through the key 30% level, multiple groups, sectors at the same time, making jumps up from the lower zone back through that key 30% level. So even though they're still be considered in the stage 4 zone and moving back into stage 1 area, that's when the potential for good entry points can come. You start to get stage 2 breakouts in the leading stocks in the group and sectors, even though the sectors themselves are still obviously quite low down. So you want to be looking for, if we start to see shifts up, you want to start to be looking for leaders. So at the moment, with everything so obviously heavily oversold as such, it can get more oversold. I think I wrote in the piece yesterday, like, don't jump the gun, as oversold levels can get much more oversold. So wait for the positive signs. In the meantime, buckle up and proceed with extreme caution. So if we look down into the individual charts of these, I updated the data for these yesterday a little bit more. There's still a few gaps to fill in the consumer staples, real estate and utilities. Before it was there, the areas that we trade less, they were less important to fill. So I made sure I did discretionary, healthcare, communication services, energy, technology, etc. So most of these have now got more up-to-date data in them. So you can see the entire stage 4 decline that they've had. For example, technology here, consumer discretionary, see the little spikes. So recently we've obviously had some decent spikes in a few of them, but it's then come back off again. So we're back near the lows of the range again in all of these. Energy has been the most choppy area, and so up above the 40% level again at the moment, as we said, back in stage 1 to stage 3 zone again. But technology has come all the way back off into the lower zone. So we had this brief pop. So in previous moves, when we've had the move out of the lower zone, it's continued on, and we've moved back into stage 2. So this is different behaviour that we've seen with these moves this time over the previous 2 stage 4 declines. We're actually it's shown a much weaker market than we've seen during the 2020 stage 4 decline and the 2018 stage 4 decline there. I haven't got the data going back further. It'd be useful to look back at some older ones. So if I get time in the next few weeks or months or so, I might go back and look at some of the older bear markets and see how they fared as well. But I would imagine, obviously, we had some brief spikes up like this and then moves back lower. So you can see real estate has been hovering for multiple weeks now. I think 4 weeks now in below 5% for real estate. So really, really weak action down there. It's by far the weakest of all of the sectors. So all of them, as I said, have come back off after that spike, but they did, as you can see, had dramatic moves up, short covering rallies. So there is a lot of potential, a lot of pent-up energy if we do get a sudden shift back towards bullish again. There's obviously lots of people waiting on the sidelines ready to jump back in. But there's obviously a lot of people that have had a lot of damage done. So how quickly that goes, I would say, from what we've seen previously, the areas that moved the quickest, technology, consumer discretionary, the healthcare, we saw some big bounces in those kind of areas. So they're potential areas to look at if we do get another move up in the near term once earnings start coming out. So, on.